Welcome to our lecture on groups. Today we're going to focus a little bit on IAS 27, a lot on IFRS 10 in terms of our groups principles, and for our full program students there will be a separate video in terms of IFRS 12. Now this is your summary revision page. As always, please remember that you need to make this your own, therefore add notes, you need to make this your own. I'm going to break this page down into sections and we're going to look at each section closer, and I'm going to try to take the fluff out of the standards and focus on the core principles. Right, now first I want us to spend a bit of time on IAS 27 paragraph 10. Before we look at this paragraph, let's just take this one step back. We have an entity called P Limited. P Limited has to prepare annual financial statements in terms of IFRS. Now, during the year, P Limited purchased shares in S Limited. At this point of time, we don't know, is this a subsidiary, a joint venture, or an associate? But the main thing here is that IAS 27 paragraph 10 indicates to us in the separate financial statements of the parent, which will be P Limited. P Limited can account for the investment in the subsidiary, JV, and associate at either 1, at cost, 2, equity method, or 3, IFRS 9. Now, for SICA's purposes, you don't need to know equity method or IFRS 9. Therefore, IAS 27 paragraph 10 indicates to us in the financial records of P Limited, for this investment, P Limited will then debit the investment in S. It's an asset, it will increase at cost price. Let's say purchased cash, therefore credit bank, asset decrease. And if there is a different method of payment, credit that account, and we will look at this in terms of our IFRS 3 principles. Right, therefore if we now look at this in the separate records, now why do I repeat this? At the end of each year, I still identify that a lot of students struggle. They don't understand what do I mean by separate records. In the separate records of P Limited, in the separate annual financial statements of P Limited. Okay, now let's take this one step further. When we look at groups, you need to be able to distinguish between the following 3 types of investments. An investment can either be a subsidiary, or an associate, or a joint arrangement. For a subsidiary to exist, we will have to prove that there is control. This is important normally in terms of discussion questions, therefore you need to know control. If we look at the shares, normally when there's more than 50%, we can debate that there is control. But if there is less than 50%, we need to look at the de facto method. We are going to spend a lot of time on this just now. And in terms of the accounting for the group, look at this, important. In terms of the accounting for the group, we will consolidate. Now, what is a group? When you look at P and S Limited, if we consolidate these 2 entities, Sumunye, we are now one. These 2 entities will now be seen as one entity. Therefore, we will have to add all of the assets and liabilities of P Limited plus all of the assets and liabilities of S Limited. We are now one entity. We consolidate. We're going to spend a bit of time on this in today's lecture. Right, the second type of investment is an associate in terms of IAS 28. This will be when there is significant influence. If P Limited has significant influence over S Limited. Normally this will happen when there is 20% or more shares and there is a criteria that we are going to look at when we touch on IAS 28. And the accounting method in terms of our group, which will be the two entities, we need to equity account. Then the third investment can be a joint arrangement in terms of IFRS 11. This will be when there is joint control. They share, joint. Normally, guys, this can be when there is 50-50%, but we need to spend time on the agreement between the entities. And the accounting will depend on what? Once we determine that there is control, we will have to look at the agreement a bit closer. And based on this, this can then be a joint venture or a joint operation. If it's a joint venture, we will follow our equity accounting principles. Right, now, we need to first determine, for this to be a subsidiary, Sumunye, we are one entity. We need to first identify if there is control. Now, this is your important principle in terms of IFRS 10. Therefore, I want you to please open your IFRS 10 contents page for me, please. Remember, you do have this available, but you need to ensure that your standard works for you and not against you. My recommendation, as always, add your note, indicate that this is IFRS 10. Please remember, you're not allowed to write in your standards. You're allowed to highlight, underline, subline. Now, the important principle here is we need to determine if there is control. If there is control, yes, we know that the investment will be a subsidiary and we know we are able to consolidate. If there is no control, we need to take this further, identify if this is an associate or if this will be a joint arrangement. Okay, now when will control exist? When, number one, there is power. This power should give the investor exposure to a return. Any type of return, guys, a variable return, dividends, losses. And we need to be able to link the power and the return. Remember, the power should give the investor the right to a return. Remember, we want to be able to identify if this entity is now one. There should be power. Therefore, if I'm you, and this is my standard, I will include a smaller flag at paragraph 5, just to ensure that I am familiar with the principles. Therefore, if you open paragraph 5, remember, you need to be able to discuss in a theory question. This is rules. If you look at paragraph 5, it indicates an investor, regardless of the nature of its involvement with an entity, shall determine whether it is a parent by assessing whether it controls the investee. Now, when will it control the investee? If you look at paragraph 7 for me, number 1, when there is power, and because the standard indicates us all of the 3. Number 2, the exposure or rights to variable returns from its involvement. And number 3, the ability to use the power over the investee to affect these returns. Therefore, this is your link. Right, and when you look at this, you are able to open these paragraphs 10 to 14, 15 and 16, 17 and 18. I am, however, going to make use of the notes. Remember, IFRS is copyright protected. I'm only allowed to use about 30% of the actual standard throughout my lecture. Let's take this one step back. When you look at the right side of my screen, the bottom, remember we have P Limited, which has an investment in S Limited, and we now need to identify if P Limited has control over S Limited. Remember, control will exist when we are able to identify that there's power over the investee plus exposure or rights to variable returns plus the ability to use the power to affect the return, which is the link between our power and return. Therefore, first, we will have to identify if there is power. Now, when will power exist? When there is an existing right that gives current ability to affect the relevant activities of S Limited. Now, unfortunately, we have to work through the theory. We are going to look at a few examples as well. Now, if we only look at power, existing rights, what is an existing right? It is a right where the holder has the practical ability to exercise, therefore to be able to use that right. And this is a substantive right. Only substantive rights can be exercised, and it's an existing right. Therefore, the holder will have voting power over the entity. Now, if you look at my example on the right side, this will be, for example, if P Limited has voting power to be able to use its rights at an AGM in terms of S Limited, we can debate that there is a substantive right, existing right. Right. Okay. Now, if P Limited has more than 50%, it's pretty straightforward. Normally there will be control, but you need to look at the information provided in a scenario. But these rights can also be potential voting rights. Therefore, it can have the potential to give P Limited the right to vote. Therefore, if you look at B47, it will only be considered if it is substantive, therefore practical to exercise. They should be able to use the right. And it can arise from a convertible instrument. Therefore, there can be an instrument which can be converted into shares. And the share can be exercised. And it has to be currently exercisable. They should be able to exercise this now. Right. Now, if we look at substantive rights on the right side of your screen, a substantive right can be when the shareholder has the right to appoint, reassign, or remove key management personnel or another entity. Therefore, if you look at my example on the right side of your screen, what's the purpose of key management personnel in any entity? This is my key management personnel. What is the purpose? The purpose of key management personnel will be to manage that entity to be able to generate profit and loss and to be able to continue in future. Now, why will I purchase shares in an entity that's going to liquidate in a month or two's time? No, I want to be able to benefit from the profits in future. Therefore, the standard indicates to us if an investor, which is P Limited, has a right to appoint or remove these people or an entity, that P Limited has a substantive right and that there will be power. Then, right to direct the investee to transactions for the benefit of the investor. If you look at the right side, P Limited want to be able to direct which decisions do we need to make to be able to benefit P Limited, be able to receive a profit from this investment, a dividend. If P Limited is able to make these decisions or direct the investee to be able to make the decisions, P Limited will have a substantive right. And then there might be other rights which you will have to read in the scenario. Okay, now if there is a scenario where there is an investment but there is less than 50% investment. We need to look at the de facto control. Therefore, we will have to identify if there is a contractual arrangement with another vote holder. Therefore, if there is a separate agreement, a contract between two vote holders, vote holder 1 plus vote holder 2, if together they are able to vote on decisions affect the entity, there might be control. Number 2, we need to identify what is certain rights from other contractual arrangements. It might be that P Limited owns 40% in S Limited, but there is a separate contract that specifically gives P Limited power and voting rights. And we will have to look at the investor's voting rights in detail, because it might provide the investor with a vote which will give the investor control even if the investor has less than 50%. Right, now we're still looking at power. Current ability. Now you will have to read a scenario and you will have to use your professional judgment. Current ability. Do they have the ability now to be able to affect relevant activities of S Limited, the investee? Now, let's say, for example, S Limited is a transport company, and the relevant activities of this transport company will be logistics. Therefore, P Limited should be able to make decisions in terms of the logistics, the traveling of, in terms of contracts. Any possible research and development in terms of possible warehouses for goods that they need to transport. Any acquisition or disposal of any trucks. And if they need any funding. Therefore, the relevant activities of this company to be able to generate profits at the end of the year. Therefore, if we are able to identify in a scenario that there is existing rights that is substantive, that give the investor current ability to affect the relevant activities, we are able to conclude that there is power. But you will have to mention what is the relevant activities, what type of right exists. Right, now we have concluded on power, exposure to the variable returns. Now, it is important here that you are able to identify that these returns can be positives and negatives. If you buy shares in an entity, you hope that there will be profits, but it might be that there's going to be losses, and then the investor will have to act up and take these shots. Plus, then the ability, number 3, to be able to use the power, to be able to affect the returns, to be able to make the decisions, the ability. They have the right, they may use it, they may exercise it to be able to affect the income of the entity. I want you to please open IFRS 10 B24, and we are going to work through a few examples.